Hello everyone, how's it going? In this video, we're going to be talking about Lucid, trading under the ticker symbol LCID. Now, if you're looking to buy or sell Lucid motor stock, then please keep watching because we're going to look at the company's recent news, how the market's reacting to it, and what are the technicals telling us. We're also going to try to figure out what is the best trading approach given the circumstances. As the market remains volatile at the moment, it would be mindful to choose which positions to pick, as well as their individual timing and exposure very carefully. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Recently, Lucid traded around $5.50, which is relatively low compared to its already massively depreciated share price. Over the past 5 days, it went down by 7%, and over the past 6 months, it went down by almost 30%. $7 seems to be a ceiling for Mullen in the short term that Lucid cannot really pierce through. And so far, the $5.50 level has been a support at one point, at least in the past, a couple of months ago in the summer of this year. Meanwhile, the company continues to show signs of resilience, trying to scale up its production and continue the target of reaching profitability. It's going to be a journey, not necessarily that long, but it's going to be a journey, all right. And I think that they will ultimately be able to pull it off. It is, after all, one of the more successful unicorns from the 2020 era. With that being said, let's take a look at the technicals. The trading volume of Lucid is around 28 million shares compared to the average of 24 million shares. Over the previous 52 weeks period, the price fluctuated between $5.44 and $17.81. The volume of shares traded tells us how many shares are being bought and sold at any given point, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current volume against the average volume, there might be a possibility for trend reversal or breakthrough if the difference is very large. For example, if it were to break through, the current volume of the stock would be significantly higher than the average volume. The market cap of Lucid is around $13 billion, compared to the enterprise value of around $12 billion, meaning there's a slight premium above its book, like the book cost. As we compare the current price to the historical price fluctuations, it's 1% higher than the 1-month low, 1% higher than the 3-month low, and 1% higher than the 52 weeks low. In other words, it's very close to where it has been in a past that's now pretty long. Like, we're talking the past 52 weeks, right? So yes, it is at a very cheap price level. On the options market, which may give us a hint on the market sentiment on where the stock price could go next, the implied volatility is 61% compared to the historical volatility of 50%. The put-call volume ratio is currently around 62%. It's normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 66,000 contracts a day versus the 30-day average of 57,000. Now, for the open interest, the most recent volume of open interest is 1.1 million contracts versus the 30-day average of 1 million contracts. In terms of the shareholder structure, institutional shareholders own 73% of the float, likely as a result of both short selling but also genuine institutional long positions. The biggest shareholders include BlackRock, Invesco, and Vanguard. It's always good to see some institutional participation when holding a stock long-term because it may offer a layer of stability and a token for reliability in the medium to long term. It also means that the market is confident that it's going to deliver like what they promised over time. which is a very important factor to consider for us, the investors who want to stick in for the long term. I believe that a minimum threshold is around 25 to 30% of institutional ownership. There's many exceptions to that rule, but there you go. The current short interest is around 21% of the total float and 55% of the transactions from dark pools. Usually, if the short interest is above or around 15%, we may have a case for a short squeeze. So I would say that for Lucid, there might be an argument for a short squeeze. In other words, if it were to rise in price, the short squeeze is going to trigger a lot of mass redemptions for the short positions, which will push the stock price to even higher places. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. So, here's my overall recommendation for Lucid given the information available. I think that with the share price of Molen very close to all-time low, it's better to have some in your portfolio and to wait for the storm to pass. The upcoming recession might be ugly, alright, but it doesn't mean that there will be no hope for the company. EV is a trend that is here to stay, that's for sure. And as long as this assumption remains accurate, Molen will be able to pull it through. I would recommend to commit between 3 to 5% of your portfolio in this stock. I would also recommend to split the allocation in 20% batches over the next 6 months or so that you can purchase more in case it retraces.